Have you ever wondered how someone actually puts a price on the future? It sounds kind of impossible, right? But that's pretty much what an option price is. It's a bet on what a stock might do. So in this explainer, we're going to pull back the curtain and see exactly how that price gets made.
All right, let's get our hands dirty with a real-world example. Here are the numbers for a call option on a stock. Ticker, DCRB. So the stock itself is trading at about 126 bucks. The option, it gives you the right to buy that stock for a flat $120. And the price for that right, for that possibility, is exactly $7.
So that's the big question, isn't it? Where in the world does that $7 come from? Is it just a gut feeling? Someone throwing a dart at a board? Well, the answer is a hard no.
It is not a guess, not even close. It's the result of a really logical system. And that whole system is built on one single powerful idea: preventing something called arbitrage. Now, that's just a fancy word for making a risk-free, guaranteed profit. The entire pricing model is set up to make sure there's no such thing as free money.
Okay, so to crack this puzzle, we first need to split that $7 price tag into its two main pieces. You see, every options price is a blend of what it's worth right this second and what it could be worth down the road.
The first part is the easy one. It's called intrinsic value. Just think of it as the cold, hard cash value. It's the profit you'd pocket if you use the option this very minute. No speculation, just the facts on the ground.
And the math here? It couldn't be simpler. With our DCRB option, you can buy the stock for $120 when everyone else is paying almost $126. So if you did that right now, you'd make an instant profit of $5.94. And boom, that's its intrinsic value.
Okay, so hang on. If the total price is $7, and we now know that $5.94 of that is its immediate cash-in value, well, that leaves a little bit of a mystery, doesn't it? What about that other $1.06?
And that extra little bit is called time value. This is where it gets really cool. Time value is, quite literally, the price of possibility. It's the premium you pay for the chance, the hope that the stock price climbs even higher before your time runs out. You're paying for uncertainty.
So, how do you put a price on possibility? Is it just random? Nope. The market follows some really strict logical rules that create boundaries for any option's price. You can think of them as the absolute floor and ceiling for what an option can be worth.
And these rules are super intuitive when you just think about them for a second. The floor, why would you ever sell an option for less than you could cash it in for right now? You wouldn't. So its price can't go below its intrinsic value. And the ceiling, why would you pay more for just the right to buy a stock than for the actual stock itself? Again, you wouldn't. So the option can't be worth more than the stock.
Now, if you dive into the academic side of things, you'll see these simple rules written out in formulas that look, well, pretty terrifying, like this one right here. But please, don't let all the symbols and letters scare you off. Because hiding behind all that complicated-looking math is the exact same simple idea we started with. You guessed it. It's just another no free money rule, but dressed up in mathematical language. It's a formula designed to stop anyone from finding a guaranteed, risk-free payday.
So somewhere between that floor and that ceiling, the options price dances around. And its movements, especially the time value part, are controlled by four key factors. Think of them as four big levers that are constantly being pulled.
So, what are these four levers? Well, we're going to look at each one. First up is time to expiration. Then you've got the exercise price. After that, interest rates. And finally, stock volatility.
Let's start with the first and probably most intuitive one, time. It seems obvious, but how does having more or less runway before your option expires actually change what it's worth? Well, check this out. These are the actual prices for our DCRB option. Same $120 exercise price, but with different expiration dates. The one that expires in a week, it costs about $7. Give yourself over a month to expiration, and the price jumps to $8.50. Give yourself 2 full months, and it's nearly $10. The pattern here is crystal clear. And the logic is just so simple. More time means more possibility. More time for news to break, for the company to succeed, for the stock to make a huge upward move. And since that's exactly what you're hoping for when you buy a call option, that extra time is worth paying for. The other 3 levers work on a pretty similar logic. A lower exercise price? Well, of course that's more valuable. It gives you a cheaper entry point. Higher interest rates actually increase the value too. Why? Well, because owning the option lets you control the stock without tying up your cash, and that cash can now sit in the bank earning you more interest. And finally, and this one might seem a little weird at first, higher stock volatility makes an option more valuable.
But the reason volatility is your friend here comes down to this absolutely crucial principle. As the option buyer, your downside is capped. You can only ever lose the premium you paid. That's it. But your upside, it's theoretically unlimited. A super volatile stock has a much better chance of a massive price spike, which is pure profit for you, while your risk stays exactly the same.
So when you put all of these pieces together, you start to see that an option's price isn't some number pulled out of thin air. It's actually the logical conclusion of a system designed to place a rational bet on what tomorrow might bring.
So, let's wrap this up. What have we learned? Well, first, an option's price is based on logic, not magic. Second, its value is always a combination of certainty, that's the intrinsic value, plus possibility, the time value. Third, that price is always fenced in by rules that prevent those free money arbitrage opportunities. And finally, we know there are 4 key levers constantly pushing and pulling on that price.
And that leaves us with one final thought to chew on. Now that you know the principles behind the price, does buying an option feel like a truly calculated risk, or is it still, deep down, just a shot in the dark? Thanks for watching.